Hi everyone, I'm James Harte from Little Fish FX, and thank you for joining me for this week's live market analysis session, where we are of course going to be talking about tomorrow's big event, the August Bank of England meeting, the Super Thursday meeting. Now, before we get into discussing the event tomorrow, let's just quickly recap what we saw from the Bank of England at their July meeting. So investor expectations ahead of the July meeting were tipped in favor of a cut, with the rate swaps market pricing in more than 60% probability of a cut. And the Reuters poll, which is a poll of industry analysts conducted by Reuters ahead of major events, up until the day before the meeting, was actually suggesting that the majority of analysts were expecting rates on hold, though on the day of the meeting it actually tipped in favor of a cut, with analysts expecting a 25 basis point cut. And indeed, one member of the MPC did vote for a cut. However, the Bank of England didn't cut at its July meeting. So besides the one member who voted in favor of a cut, the rest agreed to keep rates on hold, judging that they needed more time to assess the data post-Brexit before making a decision. The bank did, however, give a strong signal that easing was likely to come at the August meeting, at which the bank promised to conduct a thorough analysis of all available policy options and saw a loosening of policy as likely, with most members of the committee expecting monetary policy to be loosened in August. So the upcoming meeting, as I mentioned, is one of the bank's Super Thursday events. So this is where we have the updating of the quarterly inflation reports alongside the rate decision and monetary policy statement, and also the release of the meeting minutes alongside a press conference. So there is a huge amount of information for the market to digest. Now, in terms of thinking about some of the information that's likely to be referenced tomorrow, let's quickly recap some of the data points that we've seen since the last Bank of England meeting. And it's been quite a mixed bag in recent weeks. So we had June CPI coming in at 0.5% versus 0.4% on the headline reading, and 1.4% versus 1.3% on the core reading. Similarly, we had second quarter GDP printing 2.2% versus 2.1% year over year, and 0.6% versus 0.5% quarter on quarter. However, the July GfK consumer confidence reading marked a 7-year low at -12. Unemployment rate was 4.9 versus expected 5, and earnings 2.3% versus 2.3%. So some steadiness there. Retail sales, however, in June, 3.9% versus 4.8%. And then, of course, we had the July PMI readings, with services, manufacturing, and construction all printing sub 50. Service sector data specifically fell to an 88-month low. And these three PMI readings, all printing below the 50 mark, marked the fastest economic contraction since 2009. Alongside this, we had the consumer confidence, which hit a 7-year low. So this data together, coming as the first data post-Brexit, sharply highlighting concerns for the UK economy in the wake of that development. Now, obviously, the positive data prints from June CPI and second quarter GDP lose a little relevance as they reference the pre-Brexit period. And so for now, the key post-Brexit data sets have all been pretty dire. Worth pointing out that at this stage, we haven't had any hard data. So we've only had initial survey data, though obviously this is likely to weigh on the BOE very heavily ahead of tomorrow's meeting. Indeed, we saw traditional hawk Martin Wheel, who even recently was arguing that a rate cut was not needed, actually in recent days change his stance in support of easing. So looking ahead to the meeting tomorrow and considering market expectations, well, given the clear signal given by the BOE in July, markets are widely expecting easing measures to be rolled out tomorrow. Indeed, if we look at the CFTC positioning data, you can see that sterling shorts are actually at all-time highs here, indicating the extreme level of market anticipation ahead of this event. Now, of course, this creates a problem for the Bank of England because with markets so heavily expectant of easing, there is actually a high risk that the BOE falls short of satisfying expectations, or indeed is unable to deliver enough of a surprise to provide a catalyst for meaningful downside. And actually, if we look at this chart and we consider previous times when positioning was at such extreme levels, you can see that at each of these points that positioning reached these extreme periods, this was typically followed by a rally in sterling. So looking back at the 2009 period, where positioning moved down to minus 50,000 contracts, you can see that shortly after that, sterling rallied. Looking into July 2010 then, and again you can see we moved down as far as 70,000 contracts, minus 75,000 contracts, and again shortly afterwards, after we reached those extreme levels, sterling rallied. Now the same was true of this period here, although the movement was a little more sideways. And then the last time that we reached such extreme levels, which was actually in summer 2013, you can see that we reached down to, I think it's around minus 78,000 contracts. And then shortly after that, we got a near 2,000 pip rally high in sterling. So interesting to note that all of these previous episodes of sterling positioning, sterling short positioning, being so extremely stretched to this region resulted in a rally in sterling. So there was a clear risk ahead of this meeting then, with positioning so stretched that if the BOE failed to deliver tomorrow, then we could see a rally higher in sterling. And actually some further considerations that support this view is when we consider the dislocated way in which currencies this year have been reacting to rate cuts and to easing measures. So if we think about the Bank of Japan, who cut rates into negative territory in January this year, although we saw the Japanese yen selling off initially on the day, it then proceeded to reverse and rally over the next 7 months. The Reserve Bank of New Zealand similarly cut rates in March, and Kiwi dollar is now over 600 pips higher than the level it was at when the Reserve Bank of New Zealand cut rates. The Reserve Bank of Australia cut rates in May this year, and despite some initial weakness in the days and weeks following that cut, those losses have now been reversed. And following their August cut just this week, overnight on Monday, losses were actually reversed the next day. So when we consider this disturbed relationship between price action and currency rate cuts rather, then the outlook becomes a little problematic when we look ahead to the BOE meeting tomorrow. And what is causing these events is actually quite hard to pinpoint. The precise mechanism that is driving these moves is hard to pinpoint, but it appears to be a combination of the high level of market expectation ahead of these events and the fact that these moves are so well priced in ahead of time, and then also the deteriorating level of effect that these conventional policy moves are having in the post-global financial crisis world, where banks have been slashing interest rates for nearly a decade now. So looking ahead to what measures we might expect from tomorrow, and we have a few clues that we can go on. So in May, we saw Bank of England Governor Carney noting that the BOE is still in conventional monetary policy space, indicating that a rate cut is likely to be the bank's first choice. And indeed, majority of analysts are expecting a reduction in the headline interest rate by 25 basis points, which will take it down to plus 25 basis points. So at this stage, a 25 basis point cut is fully priced in, although obviously some analysts are expecting that this will move lower down to the zero bound. Now, the BOE has clearly communicated in recent months that it has no intention of moving into negative rates. And Carney has oftentimes warned against the dangers of such a move and pointed to the inefficacy of these policy adjustments in other regions. Now, with the Bank of England having refrained from cutting rates at its July meeting, and there seemingly being some anxiety about cutting rates too low, with concerns aired by Carney, Chief Economist Haldane, and also the more hawkish Forbes, it seems that a 25 basis point cut alongside some other policy adjustments is the likely route. So if we consider some of the comments that we've had from these MPC members, then Forbes specifically noted that, unfortunately, easing monetary policy not only has benefits, but also costs. People will earn less on their hard-earned savings, potentially cutting back on spending to reach a target savings pot. Banks will make less money, potentially making it harder for consumers and businesses to get loans. Pension and life insurance funds will have a harder time meeting their commitments. Companies may need to put more money into pension schemes, leaving less to spend on workers and investment. And there is also the traditional concern from looser monetary policy, inflation. Carney himself also noted that, as we have seen elsewhere, if interest rates are too low or negative, the hit to bank profitability could perversely reduce credit availability or even increase its overall price. So when we consider these comments and other sentiments expressed by the BOE over recent months, it seems clear that the BOE are hesitant to move down to the zero level, and the weight of tomorrow's measures are likely to include other options. So some of the other options that analysts are considering ahead of the meeting tomorrow are a resumption of the bank's quantitative easing program and also a resumption of the bank's funding for lending program. However, again, worth pointing out that at this stage, market consensus is aligned around a rate cut and nothing else. So the majority of analysts aren't actually expecting the BOE to initiate more QE tomorrow. And the reasons for this really stem from the differences between the current climate and that of 2008. So with the absence of a significant strain on financial sector solvency and liquidity, and with yields at historic lows, there doesn't seem to be a clear driving need at this point in time to resume QE gilt purchases. And so what might be more likely at this stage is an extension of the funding for lending scheme with a nod to perhaps reigniting QE further down the road, potentially at the next Super Thursday meeting in November. However, considering this, there is of course clear downside risk here if the bank does decide to expand its asset purchase program, seeing as this isn't currently priced into the market. And this could be the catalyst for fresh sterling downside. What is clear at this stage, however, is that the Bank of England is under pressure. Fundamentals are pointing to economic deterioration. Political pressure is weighing also. We had new Chancellor of the Exchequer saying recently that the initial response to this kind of shock must be a monetary response delivered by the Bank of England. So there's obviously some political leaning there. And then also, as we talked about, we have a very highly expectant market, with the BOE having clearly nodded to August easing and with positioning at such extreme levels, the bank will no doubt be fearful of a loss of credibility and a market backlash if they fail to deliver tomorrow. So with that in mind, alongside any easing measures rolled out tomorrow, we can expect a heavy side order of dovish rhetoric, with the bank signalling their readiness and willingness to do more, similar to the vein expressed by the ECB. Now, in terms of gauging the likely market reaction to the potential outcomes tomorrow, it's a little tricky because, as we discussed earlier, the transmission between monetary policy and currency movement has been quite dislocated this year, suggesting that rate cuts and currency weakness are not necessarily married to one another. However, in terms of seeking to identify potential scenarios and opportunities, I think given the extreme level of positioning and market expectation and how much is priced in, that if the BOE does the bare minimum tomorrow, e.g. if they just cut rates by 25 basis points with no further policy adjustments, then sterling is likely to rally on disappointment as some of those shorts start to cover. Now, if the Bank of England cuts rates beyond 25 basis points, then I think that there is room for sterling to spike lower, in the short term at least. Now, if the Bank of England cuts rates at any level tomorrow and accompanies this with an expansion of QE, then again, I also think there is scope for sterling downside in the short term. However, this really is the key takeaway. Referring back to the level of positioning in sterling, it feels as though sterling is going to struggle to move meaningfully lower. And whilst a surprise tomorrow might see some short-term sterling weakness, I think before long, we are at risk of seeing a sizable rally manifest. So with that in mind, let's take a look at the charts now and see where we are on the technical landscape ahead of tomorrow's meeting. So kicking off first of all with cable then. And for those of you who were in the session last week, you remember that we were looking at this 131 level. Let me just clear some of the lines. We were looking at this 131 level support as being the key short-term pivot. We were looking at this ahead of the FOMC, expecting that if we had a hawkish tilt to the FOMC, then we were going to see sterling break down through that level. However, the FOMC fell short of giving any sort of timing signal or timing reference, and markets were essentially disappointed. So this, accompanied by a slew of weak data out of the US, saw the US dollar selling off into the end of last week and over the start of this week. And so we did in fact see that 131 level hold as further support, and price has broken out to the top side. So looking at the current technical landscape in sterling dollar, then it seems as though we have an inverse head and shoulders pattern here. Okay, so this is a classic bullish reversal pattern, and the neckline, as denoted by this yellow bearish trend line, you can see we've got a sloping neckline here. So the key pivots for this pattern, the key breakout reference points, are initially this bearish trend line coming in at around the 134.30 level, and then of course the highs of this post-Brexit reaction high. So if we do see a move higher tomorrow, in line with a failure on behalf of the BOE to drive sterling meaningfully lower, then we could see sterling breaking out in line with this pattern. Now, if we do get a break to the top side here, then the level which I will be watching initially, and we'll have to zoom out to the monthly chart to get some better perspective on this, is this level here. So the prior 2016 low at around the 138.50 mark. So if we do get a topside break on the back of the BOE meeting tomorrow, then we could see sterling break out to the top side and move up to retest those prior 2016 lows. And if we go ahead and bring in a Fibonacci retracement from that pre-Brexit high, you can see that the 50% retracement of that move sits just above that level. So we have some strong technical confluence there between the prior 2016 lows and the 50% Fibonacci retracement from the pre-Brexit high. So if price does break back up to that level on the back of tomorrow's BOE meeting, then this is an area where I would expect to see some stalling and some decent selling interest kick in. Now, if the BOE do deliver tomorrow and we see sterling tank, then the clear trade is a sell on the break of that 131 level support. So if we go back down to the 4-hour chart where this is clearest, so if we break down below these lows, then the clear move is simply a breakdown play to the short side, targeting a move back down into the 128.50s low. I'm a little bit reluctant to think that the Bank of England are going to be able to deliver measures tomorrow that drive sterling down below the current year-to-date low. And what I would expect if we resolve to the downside is that we get more of a range-bound scenario playing out, where we test this low initially, test this low consequently, and then probably rotate back up to the upside. But let's see what happens, okay? These plays are virtually the same across the sterling complex at the moment, okay? We're seeing the same dynamic of price being caught between the post-Brexit low and the post-Brexit reaction high. However, what is clear across the sterling complex at the moment is that there's been a lot of position squaring this week ahead of the meeting tomorrow. So you can see sterling has been rallying strongly over yesterday, and it looks to be the same thing again today. Now, this is the same dynamic that we actually saw playing out last month ahead of the July BOE meeting, with sterling rallying sharply into the meeting. We got a little exhaustion top on the meeting result, and then price traded lower. So interesting to note these moves ahead of the meeting. Looking to sterling Aussie then, and sterling Aussie, this has been an interesting chart this week, obviously, because we had the RBA cutting rates overnight on Monday, with their headline cash rate now standing at record lows of 1.5%. However, despite some initial Aussie dollar weakness, Aussie dollar has since turned higher. So fundamentally, with yields still far above those elsewhere, the Aussie dollar remains attractive, and so it's likely that the dip we saw around the RBA meeting was used as an entry point by those looking for the next leg up in the Aussie. So the key setups for me on this chart really are, if we break to the downside, we have a really nice support level, which we can look to play a breakdown through at the 173.60s level here. So you can see this is actually the neckline of this rather protracted head and shoulders pattern, okay? You can see we have a left shoulder here, the head here, and then a right shoulder here. So whilst we're holding below these levels, if we do break to the downside, then I will be looking to play that to the short side on a break of the 73 60s level, targeting a move down to the 171 level support, the year-to-date lows. Now to the top side, again, driven by this current position squaring ahead of tomorrow's meeting, you can see that we're actually starting to break out now. So we've broken out above the bearish trend line from the post-Brexit reaction high. We've actually just started to challenge this local resistance. So key to keep an eye on this ahead of the Bank of England, because if we do break meaningfully above this level, then this opens up a test of the 176.76 level, the next key resistance at the mid-July high, the late July high. However, topside moves, calling topside moves ahead of the Bank of England meeting tomorrow is a little trickier, because depending on the scale of this position squaring, okay, this might be done now, or we might see it continuing over the rest of the day and overnight. Depending on how violent this position squaring gets, we're not entirely sure where price is going to be to the top side ahead of the meeting. So it could be that we eclipse this 76 high and we're trading higher at above this level, or it could be that we fall back and we're stalling around the downside. So for now, calling a short play on this seems to be the clearer option for me. So if we do start to move back down here, okay, then I would be expecting that a break of this level opens up a test of the 171 lows. Similarly, sterling Kiwi then, and this is another really interesting chart, again displaying that same dynamic of price being caught between the post-Brexit low and the reaction high. But for now, it looks like we are heading higher, okay? You can see that we've had this double bottom pun in play. We've got two inside bars here and a bullish engulfing candle. So this is strong price action signaling of a clear move to the upside. So if we do get a break higher on the back of the Bank of England tomorrow and price takes off, then I'm actually looking at a much bigger pattern in this chart, which might present the opportunity to get short. So you can see, if we zoom out to the weekly chart, that we have this really solid ledge of structural resistance here at these prior lows over 2014 and 2015. So really good structural resistance at this key area of broken support. Now we also have some really strong confluence there, symmetry confluence between the retracement, the last retracement in this move, which is actually equal length to the current move that we're seeing. And then finally, we actually have some internal symmetry with this corrective ABCD pattern. So we have the AB leg here, the CD retracement, and if we do rally from this point and trade higher, you can see that this pattern completes just a little bit above those two levels. And then finally, we have the Fibonacci 38.2% retracement from the pre-Brexit high. So there's a lot of technical confluence there, which suggests that this would be a good area to look to play to the short side, okay? We've had this really strong impulsive sell-off from May this year in the sterling Kiwi. This could now be the corrective move, similar to the move that we saw at this level here. And if we get that ABCD up into these prior broken lows with the 38.2% retracement and some further symmetry confluence here, then I'll be monitoring price action for potential reversal plays. Now, obviously, this level being around the 92.30s, 93.60s mark is just shy of 1,000 pips away. However, this pair could achieve that in a number of days. So although it seems a little far away, this is definitely one to keep an eye on, because you never know just how quickly we could get there. Of course, we have the Reserve Bank of New Zealand interest rate meeting coming up, and it's widely expected to see the bank cut rates further. So it could be that if the Bank of England fails to deliver sterling lower tomorrow, and then the RBNZ cuts at their upcoming meeting, that could be the catalyst for this next leg up to take us up into that level. Looking ahead then to Euro Sterling, and Euro Sterling is interesting at the moment because you can see that we're currently caught at a retest of this long-term bearish trend line. So let me just get rid of some prior comment that I've written on that chart. So you can see, zooming out then to the weekly chart, that we tested that long-term bearish descending trend line on the back of the Brexit moves. We've since stalled out and started to turn lower. And so this current move is suggesting that there is room to retest at least the pre-Brexit high. And again, if we do make a move down to that level, this could be a good area to look to get long, because we have some really nice corrective symmetry with this ABCD pattern, which completes into that level. And we also have the 50% retracement from the pre-Brexit low sitting at that level also. So this is another area of really solid technical confluence, which if price trades down into could be a great area to get long. Now, obviously, euro has been supported recently because we had the ECB on hold over July, and then recent data out of the Eurozone has continued to surprise to the upside, which is weighing a little bit on rate cut expectations. Now, when the BOE, the ECB rather, met in July, they actually noted a less than expected impact from Brexit, and we heard Mario Draghi cautioning against the initial estimates of impact from Brexit. So these comments downplayed the risks from Brexit and sort of took markets a little bit by surprise. And so those sentiments, alongside some of the recent data, are actually keeping the euro fairly supported at the moment. However, if we do see sterling ripping higher tomorrow and we get a move lower in the euro, then this could be a really good area to look to position for another move up. And then finally, sterling Swiss. So sterling Swiss, a little frustrating for me actually, because I had a nice short in that pair last week, traded the breakdown of the 128.60s low here. However, you can see that price failed to break down meaningfully from that level, and we actually reversed and traded sharply higher, and I was tapped out for break even. However, ahead of the Bank of England meeting tomorrow, this is a really interesting development, because whenever we get a false break of a strong level like this, okay, if we zoom out, we can see that this level is a strong level of prior support. So the initial post-Brexit low stalled at this 128.60s level. We then had two more subsequent tests of that level. We broke down, traded back above it. And so again, like we saw with the sterling dollar chart, what we potentially have on our hands here is a large inverse head and shoulders pattern. Obviously, the right shoulder has fallen a little deeper, but that's fine. So we've got our sloping neckline here. So having broken back above that key support level, this now suggests to me that if we trade back down to retest that level a further time, this level is likely to hold. So this is an important development. The failure to break down below that level meaningfully last week and the subsequent recovery above that level suggests now that my bias is correct to shift to the top side. So in this market now, I'd actually be looking for sterling Swiss to break higher, which again, considering what we've been discussing in this session about the extreme level of sterling short positioning, the extreme level of market expectations, and some of the reasons and challenges why the BOE might find it difficult to surprise or deliver a policy adjustment effectively tomorrow, in line with these technical elements, suggests that sterling is at strong risk of breaking out to the top side. And I will indeed be watching carefully tomorrow to see what happens. Of course, it's difficult to gauge properly what the reaction is going to be tomorrow. The Bank of England could totally surprise, cutting rates to zero, launching more QE, and we could see some sharp selling. But again, my closing thought and the key takeaway simply refers back to the extreme level of positioning in sterling, which is a major red flag to me. And at this point suggests that the risk reward is really in playing to the upside, and that the path of least resistance at this stage is now for sterling to break higher. Okay, so thanks a lot everyone for joining me for this week's live market analysis. I hope that you found that useful, and I hope that you've got a clear understanding now of the levels and setups that I'm looking at ahead of the meeting tomorrow. Now, in the meantime, please head to the website www.littlefishfx.com, where you can check out all of the great education material that we have, and you can also check out the daily trade alerts, which we've been issuing since November 2015 now, and they're up over 3,100 pips. We actually have a gratitude coupon here for 10% off those trade alerts. So if you're interested in those, then please check those out on the website. And in the meantime, best of luck everyone, and take care, and I'll catch you next time. Cheers now.